So I'm Neil Hermon. I'm the fund manager for Henderson Small Companies Investment Trust. It's a role I've had for near on 20 years. I'm going to take you through a presentation to talk about the trust itself, the team, performance, and a bit of an outlook for UK smaller companies in what's obviously a very challenging period. So to start off, just myself, obviously, I said before, I was been in this role for nearly 20 years, joined Henderson in 2002. In terms of my team, there's three of us in the team, myself, Indri and Shiv. Indri joined the team back in 2013 after joining Henderson in 2011 and Shiv in 2017. So a stable team. We've been obviously working together for over 5 to 6 years now. And obviously working in a large organisation. Janus Henderson is over 300 billion of global AUM, and obviously lots of people there which contributes in terms of our overall portfolio and construction. But fundamentally, three of us are the key individuals, and exactly before we worked together for a long period of time and a very stable team overall. Just to start off, really, I suppose I'm going to give the kind of helicopter pitch for small cap. Obviously, very topical. What's been an incredibly difficult year this year, but thinking about the longer term, small cap has provided excellent returns for investors. The killer chart is the bottom right-hand slide there. You can see. So go back in 1955, so a 66-year history. £100 invested in the benchmark for the small companies, the small companies index. It's now worth £883,000. It was at the end of 21, compared to a similar investment in the all share worth £126,000. So clearly about 6 times better return from small companies over the very long term compared to large cap. Those returns work out an average outperformance of 3.3% per year, every year for the last 66 years, small cap over large cap. Now, that's a very compelling long-term returns. Why is that? Listed a number of reasons on the left-hand side of the slide here, really. Essentially, more kind of operational leverage, more entrepreneurial management teams, more deals in the face of change, and the source of new technology and services. So there's good reasons why small caps have outperformed large caps over the very long term. Now, we know small caps are historically more volatile, less liquid than large cap, and are more prone to the economic cycle, as evidenced by what's happening this year. But taking a long-term perspective, smaller companies provided very good returns for investors. Just a little bit about the trust itself, some of the numbers around it, and some of the kind of the key statistics. Its objective is to maximise your returns by investing in a portfolio of listed UK smaller companies. Our benchmark is the Numis Small Companies Index. Think of that being the bottom 10% of the UK market by market cap size. So below 1.5 billion being our kind of investment sphere for market caps. Fee structure, a very low base fee with a performance fee on top, but only if we outperform, obviously, and obviously produce positive total returns. So no performance fee is paid in a year where either the share price or NAV falls, and total fees capped at 0.9% of NAV in any 1 year. Performance, we'll come back to a bit more detail later on, but just to say it's been pretty consistent long-term performance. The year end of the trust is May. I've run the trust for now 19 financial years. We've outperformed in 16 of those 19 financial years. So good long-term returns, and we'll come back to some of the numbers around that. Size-wise, reasonably large and liquid. At the end of August, you can see here market cap over 600 million, NASA over 700 million. So no, reasonably large and liquid in the context of the space. We pay a dividend. So the yield on the trust was around 3% at the end of August, given market moves in September. It's near close to 3.5%. And we've enjoyed very strong compound growth in dividends. And that really reflects the growth of the income from our portfolio since 2003. So 22.6% compound growth in dividends. And again, I've got a slide on that later on just to run you through the kind of dynamics of that. And a differentiation of investment trusts compared to open-ended vehicles is the fact we can gear. And we have used gearing to positive impact over the course of my tenure. At the moment, gearing, as at the end of August, was 13.9%. It's a bit lower today. Obviously, we've sold one of our investments that was being taken over. And encouraging, I suppose, given recent move in gilt yields and interest rates, a lot of our debt is fixed. So 50 million of our current 80 million facilities is through 2 private placements, very long term, 2.77 and 3.33. How do we do things? So a quick overview of the kind of the way we construct portfolios and pick stocks. Now, we are bottom-up investors. We do believe that we add most of our value by researching companies and looking for the best value for investors over the longer term. The macro is important, but essentially we are very much bottom-up driven, and we obviously expect our research of those individual companies we pick. We are growth investors, unashamedly. We do believe investing for growth is the right thing for the longer term, particularly in smaller companies. But we do think valuation is important. I think the tech bubble taught us 2000, 2002 is you can't overpay for a company in terms of its valuation. So we go up, growth at the right price, growth at a reasonable price. And that approach has been consistent for the last 20 years. We've very much been we haven't really changed or had any style drift over that period of time. A very rigorous investment approach you'd expect. As a team, we see over 300 companies a year, or 300 company meetings a year. We see all our investee companies at least twice a year, and obviously at work, Janus Henderson, given we obviously are a very large organisation and have substantial assets under management, and we run over 1.2 billion in UK small cap, we have phenomenal access to company management teams. So we have great access, and we use those meetings to obviously to interrogate the management teams, talk about their prospects and the strategy and the business going forward. In terms of things we look for, we talk about the 4 M's. What are those in terms of the things we look for in the companies we invest in? First off is business model, economic franchise, competitive advantage, it's kind of strategy and portfolio forces, what else of the business. Secondly, management, clearly very important in smaller companies, often driven and led by 1 or 2 key individuals who want to assess the strategy, motivation, vision, corporate governance, and alignment with us as shareholders. Money is balance sheet and cash flow. So we like companies that have strong and sensibly structured balance sheets and strong cash flow dynamics. And lastly, momentum, trying to find those companies that over deliver against market expectations, either give us earnings upgrades and avoid the ones that give us the warnings. We do run the winners, so we do believe, fundamentally we are here to invest in things for the longer term. So a company does well and we continue to like it, we continue to run it, and obviously we are looking to be very long-term in our approach. And that leads to a typical holding period of over 5 years. So it's not a churn and burn portfolio, it's very low turnover, high conviction. And it is, as you'd expect within a kind of fund these days, clearly risk controls are in place to ensure no over concentration in stock or sector positions. We have maximum positions we can take in both stock and sectors, and we have around 100 stocks in the portfolio. Just in terms of performance, so look, I think the last year, as we all know, has been very challenging, particularly in small and mid companies, and I'll come back to reasons for that. So you can see obviously our 1-year returns have been very difficult, and I'll go run through that in a bit more detail. In terms of the medium term, still looks reasonable, obviously producing positive returns, over 3 and 5 years, and that's a period that includes both kind of COVID pandemic and the recent year, the year in terms of what's been happening with markets this year. But the key number for me really here is a longer term track record. So the relevance of the 31st October 2002, to date I joined Henderson, Janus Henderson, and obviously that's been 20 years now. And over that 20-year period, we've produced returns, compound returns of 13.7% per year every year, compared to a benchmark of 10.6, outperformed the benchmark by over 3% per year for over 20 years. And obviously the joys of arithmetic, that compounds up to a nearly 1,200% total return over that period of time, nearly double our index. So clearly, obviously the last year has been more challenging, and I can talk about that in a bit more detail. But in terms of longer term, and that's the thing obviously we're looking for because we are long-term investors, we have produced very strong returns for investors over that period of time. And just in terms of looking at it from a different perspective in terms of annualized returns, and you can see that small companies, as I mentioned earlier, although providing investors very good long-term returns, have been quite volatile. And you can see the calendar returns from the trust over the last nearly 20 years. And I think we've had 5 down years in that period of time: 2007, 2008, 2011, 18, and obviously the current year. I suppose the key thing I'd say pick from this is, I'm not sure history is a good guide to the future, but in years where we have a negative return, the following year tends to be quite good, apart from 2007, because obviously 2008 was a GFC. But actually, we do tend to bounce back quite quickly in small cap. So although things look quite bleak at this point in time, I would say history tells us that there is generally a very good rebound from lows. I just pick up on this year, because obviously clearly it has been a very difficult year, and obviously we're all found equity markets challenging this year. I suppose why has this year been so difficult? And I think a number of reasons why it has been a very challenging year, and I'll go through those in order. Probably the least important from a kind of from market perspective is COVID. From a perspective of Western economies, you could argue that COVID is essentially done. There's no quarantining, there's no kind of restrictions, no real testing going on. But it has been an issue for Asian markets, particularly China, with a zero tolerance COVID policy. That's meant Chinese economic growth has been slower than expected this year, but it has also affected a lot of Western companies because obviously China is very important in the global supply chain. And that's meant we've obviously seen problems with obviously escalating costs from a supply chain perspective, but also just getting goods to customers have been difficult. Wars are never very good. Clearly the Ukrainian conflict, the humanitarian disaster that it is, but from an economic perspective, I mean, Russia, Belarus and Ukraine aren't that important globally from an economic perspective. However, what has impacted markets is clearly a kind of a significant change in geopolitics globally, a higher risk premium for kind of a risk assets. Russia's a pariah state, increased Western spending on defence. But I suppose what happened around the conflict time was clearly a big escalation in raw material prices, particularly food, metals, and oil and gas, and particularly gas. Now, obviously, some of those things have rolled over. You look at things, the charts on, the kind of on metal prices. Copper's well below where it was at the start of the year after spiking. Food prices are well below where they were at the peak of the just after the invasion. But what hasn't gone away is clearly the issue around energy and oil and gas. Although the oil price has come back quite a bit in the last couple of months, gas prices remain inflated. Clearly, we all know the impacts of Nord Stream 1 and Nord Stream 2, and Putin turning the taps off, and obviously European gas prices are extremely high, and that's leading to that point about cost of living crisis. Western consumers, particularly European consumers, are not enjoying, but certainly seeing significant inflation in some of their basic costs: food, energy, fuel. And although employment is high, wages are going up, and there's a degree of savings built up during the COVID crisis, there is a degree of, clearly obviously pressure on the consumer. We're seeing record low confidence, consumer confidence at this point in time. I think the most relevant point though is central bank policy. We've gone from a position where at the end of 21, central banks are generally pretty dovish about the outlook. Inflation was transitory, that's also called at the time, and monetary policy was very loose. So we had QE and low interest rates. That's clearly progressively changed throughout 22. We've moved from QE to QT, quantitative tightening. We've seen central bankers become more and more hawkish as the years gone on. We've seen inflation clearly move up beyond where we thought it would do, and interest rates continue to rise throughout the course of the year. Now, that's clearly provided the market with a lot of challenges, and obviously, as we stand today, given the central banks led by the Fed, but followed by the ECB and the Bank of England, are pushing rates up to a point where we're likely to see a significant economic slowdown, if not recession. And they're clearly looking to see demand destruction to bring inflation back into control. So not difficult environment for equities in general, and additionally, in the context of our own portfolio, being growth investors, we've seen a derating of our portfolio generally. Clearly, the point about higher long-term interest rates and discount rates means that growth companies whose cash flows and earnings tend to be more in the future, those are worth less as you discount them more with a higher discount rate. So clearly, obviously, you've seen a significant underperformance of growth companies versus value companies this year as the market is derated. And obviously, last week has clearly not helped at all with the market reaction to a potentially unfunded massive tax cut, which obviously has added further grist to the mill. So look, I mean, it's a challenging macro environment, and let's not get too gloomy. Why can we be positive? Well, I think there's a number of reasons why we can be positive. From our perspective, corporate profit performance has been robust. You look at our portfolio, earnings of the portfolio has grown by nearly 20% this year, forecast to grow by other low teens next year. We do recognise it's going to be tough as we go through it, but I think generally the performance of our underlying portfolio has been strong. Valuations have been compressed. And certainly we've seen a massive derating of companies in the UK market. You see here in the slide here how the overall market has derated materially in the course of this year and is well below long-term averages of 10 and 20-year averages. We're seeing significant corporate activity in the UK market. A lot of M&A is going on in our market currently, evidenced by just a chart here showing some of the deals that have happened in the last couple of years. what we're seeing is a lot of inward buying of UK equities by foreign and overseas and private equity. UK equities are cheap. The pound is very weak. Our companies are very cheap and they're getting bought. Balance sheets are strong, clearly very important in times of economic stress. Very different to the GFC back in 2008. If you look at our portfolio, over 55% of our value has not got net cash. Only 5% has got debt over 2 times EBITDA. So, balance sheets are strong. There's no financial distress in the market. We are seeing good growth in dividends. We are seeing companies buy back their own stock, and we are seeing director buying. And if I had £1 for every CEO who told me the stock was cheap, I'd be a much richer man today. And I think, clearly, exactly, the micro environment is not that bad. The macro looks bad. And I think you've got to remember that, smaller companies have already materially underperformed larger companies this year by around 20% if you look at the kind of the Numis index compared to the FTSE 100. Markets move ahead of the reality. So we're already discounting quite a lot of the bad news that's already evident within macro environments. So yeah, macro difficult, micro much more positive. Clearly, conscious of time, I kind of sort of touched on this already. This is our top 10. What I would say, clearly a diverse portfolio. Within our context of the fact it's quite a large fund, we tend to be more mid-cap biased. So generally, in terms of our assets, around 60% of our assets are in mid-cap, around 10 to 15% in small cap, and the rest in AIM. And you see a kind of diverse portfolio of listed companies, around 100 stocks in the portfolio overall. In terms of what we're doing this year, just again, this is a kind of rather busy slide of our activity. Just to pick out a couple of themes, we haven't added many new names this year. We see a lot of intrinsic value in our underlying portfolio, and therefore clearly what we've been doing is topping up on our existing positions, which we know well owned for a long period of time. Now does not feel like a time to be buying lots of new things. It feels like a time to be doubling down on what you already own if you think they're cheap enough. And that point about corporate activity, as you can see, we've had four bids in our portfolio year to date. Brewin Dolphin from RBC of Canada, EMIS from a US health company, Euromoney from private equity, and RPS a competing offer from 2 Canadian companies. So again, we're seeing that activity in our own portfolio that's going on from a kind of seeing the value within equities, and certainly our portfolio generally. Just in dividends, I mentioned earlier, the long-term track record of the fund is to grow its dividends. We've now had 19 years of unbroken dividend growth on the fund. And that's even throughout COVID. I mean, even though COVID, clearly we saw significant dividend cuts from our underlying portfolio, we still grew the dividends to our own shareholders. That reflects the fact we built up strong revenue reserves over the previous 20 years. And you can see here, this is £100 invested in, £1,000 invested in HSL back when I joined, what annual income would you have received over that period of time. And you can see that very strong growth of 23.9% and how much more income it would have produced compared to the all share. So this is the benefit of investing in a kind of a selection of profitable, cash generative, dividend growing businesses that we invest in. Outlook, I think really I've touched on this before. Obviously, we've gone through it previously. I mean, clearly the macro environment looks challenging. It will probably remain challenging for a period of time. The micro fundamentals are much more positive around the companies we invest in, their balance sheets, their prospects, and their kind of their valuation they trade on today. What could turn the market? It's very difficult at this point to pick up a catalyst, but can I pick on 2 things? I think a resolution in Ukraine will be very positive. Now, unfortunately, that appears to be nowhere closer than we previously were, so let's probably discount that happening tomorrow. But I think more importantly, it's around this perspective of when interest rates and inflation peaks. Throughout 22, the data's got progressively worse. It's disappointed the market on a number of times. The market's not been able to get its head around the peak in interest rates and where we like it to be. At some point, we are going to see inflation roll over, if not only for the base effect, but also we're seeing some sort of deflationary impact on certainly cost of goods and other inputs into the equation. And as and when that happens, and central banks get their head around that, and obviously we can see a peak in rates, there's good grounds for the market to recover. So I'm not sure when that's going to happen, but taking a long-term perspective, we think there's a lot of value in the market overall. So look, to leave you, obviously my time is up. I think it's been a challenging year. That's been for all equity markets, particularly mid and small cap. But I think we've got the bedrock of a kind of a good story longer term. We've got an experienced team of investors, well over 40 years in the 3 of us. We've got a good long-term history of outperformance. A bottom-up consistent approach to investing hasn't changed in the last 20 years. It's served us well. We have a very long-term horizon portfolio of low turnover. I would say this, a portfolio of high-quality mid and small-cap stocks, and the trust is large and liquid with competitive charges. So that's really me. Thank you for your time, and I'll be happy to take any questions.
Neil, thank you very much indeed. Okay, let's get straight on with the questions. There's a few of a similar theme, which I'll try and bring together. Starting with the universe that you operate in, I guess, is there a cap, a market size, a market cap size threshold, floor and upper limit that you set, or where do you start and where do you stop?
Yeah, so exactly. So as I said before, our benchmark is an Hermon index. That's companies between the 0 million and 1.5 billion. So that's our kind of range of new investment opportunities. As I said, we do run our winners. So things that grow, we invest in it and it's worth 500 million, it goes to being the FTSE 100. That's fantastic. We can continue to own it through that period of time. The point we're forced to sell it when it gets to the FTSE 100. Although, so I would say, so anything in that range. However, though, if you look at what we're doing, and obviously the amount of money we run, as I mentioned before, about 1.2 billion small cap, we can't really invest in micro cap. We haven't got the kind of the liquidity or size. So if you think about it, probably our real range is 200 million to 1.5 billion as a new investment opportunities.
And the next part of that was what's the typical minimum size? What's the smallest investment size?
Yeah, yeah, exactly. Any new investment unlikely below 200 million.
But how much would you seek to own? I think it's the question. So
no, that question exactly. So it's a diversified portfolio. We have 100 stocks. Those positions vary between around 0.4 to 3 or 4%. So probably our minimum investments a few £1 million, £5-6 million. So exactly that point about liquidity, we need the size of the company to be a reasonable size for us to get at least £5 to £6 million employed.
And just to cover it off, because we have had it asked, but I think, do you have any unlisted investments?
No, we don't. We don't. I don't think it's appropriate for a fund like this to be invested unlisted. I think obviously it's a different skill, different valuation methodology. We haven't invested on those unquoted and won't going forward.
And kind of following on the same kind of set of questions, the M&A takeover, M&A activity described, are there fewer quality companies, and do you think there will be fewer quality companies? Does that restrict your investment universe?
It's a question often asked, actually. Is the UK market being denuded by all this corporate activity? I tend to find, what happens is that lots of new things come along the other side of the equation. So, when we see a lot of M&A activity happening, the other side of the equation is IPOs. And although IPOs have been very shallow, very small list this year, there was a lot in 21 and years before that. So the market constantly refreshes itself. So I'm not that concerned by the fact we're going to lose every company we have ever invested in. There's always things happening on the other side of the equation, things coming through, and IPOs that give us new investment opportunities.
And a question, I think, relating to recent moves in exchange rates, and the portfolio, how much income is generated overseas?
Yeah, so analysing the portfolio, we have around half the income from our portfolio companies come from overseas. Either that's exports or originating overseas, and half come from the UK domestic. So we've got good exposure to overseas markets in that context. Clearly, the pound weakness, particularly against the dollar, is quite a good tailwind for earnings in 23, as the value of those overseas earnings are worth more in sterling.
And a question, one I thought myself, how do you differentiate the trust to the other small cap investment trusts? I had the same question come in mentioning BlackRock smaller companies and these sort of guys. What would you say your main differentiators are?
So look, I think we're all slightly different in context of the kind of where we invest our money. There's a kind of a range between value and growth and the kind of the extremes of that. Clearly the degree of asset mix, I would say we're probably more mid-cap weighted than some of our peers. The size of the trust makes a difference as well in terms of actually the liquidity of that and the underlying investors. But I think the main differentiation is the team. Ultimately, we will back ourselves in terms of our experience and our kind of our process, but we can do better than our peers over a long period of time.
And question, I think you covered it at the start, but just to make it very clear, the performance fee, what is the fee?
Yes.
And when is it paid, please?
So exactly, the performance fee is kind of on an annual basis for our financial year. It is 15% of any outperformance in a year where we outperform and actually produce positive total returns. But the fees capped at obviously the total fees capped at 0.9% of any one financial year. As I said before, clearly to earn a performance fee, we need to produce positive total returns. So we can't get paid a fee in a performance fee in a down year, even if we outperform. And the fees paid obviously after the annual accounts are published.
Thank you. Question here about China and the likelihood of them loosening up their zero tolerance policy, and that's something that we've seen here has been, it could be a big driver for a big turnaround for a lot of companies. And do you think that's likely? What's your feeling? I know no one's got a crystal ball. What do you think about that, Neil?
Yeah, I'm not an expert in China, but I suppose the kind of the commentary have been clearly, obviously, Xi's third term ratifications in November. Obviously, changing their zero tolerance policy before that's probably unlikely. So if we are going to see a relaxation of Chinese policy towards COVID, it's probably after that in November. It feels not likely, so logical they would do it, but frankly, I have no inside, I have no inside knowledge more than you do. But clearly, I think that would be a nice positive for markets if that were to happen. It has been definitely a detriment, Chinese economic growth and impact of global supply chains. Although I would argue that I think the points I made about other points which are more relevant, I think the key thing for markets, to be honest, actually is more about inflation and interest rates and central bank policy. I think we need to see a kind of clarity around the peak of inflation and a peak as to where particularly US rates peak at. As I said before, the data throughout this year has got consistently worse. At some point that will roll over and markets can actually say with certainty there we're done and obviously move on.
No, Neil, thank you very much indeed.
Thank you for your time, Zarvin. Thanks for having me.